Good morning, and good morning, guys. Welcome to another fabulous episode of Exit Strategies Radio Show. Hey, I am your host. Yes, that is me, Corwin J. Millett, broker and owner of Exit Realty Low Country Group, guys, in beautiful North Charleston, South Carolina. Hey, if this is your first time listening to the show, you, sir or ma'am, are in for a treat. Because our mission here is very simple. That is to empower our community through financial literacy and real estate education. We're legacy building. That is what we do. So, guys, look, we have been on this tangent, on this roll, if you will. And, guys, today is no different. We are super duper excited to have with us. And many of you have been kind of following us as we've kind of been delving, if you will, a little bit deeper, going a little bit higher, if you will, in our efforts to educate our community about how to leverage and how to invest in real property and real estate. And we've had all kinds of conversations. And today we're going to kind of tie in some of the other things that you could be doing to help leverage and further your career in your real estate investing efforts. So today I'm super duper excited. I'm super humbled that he's taking the time out of his schedule to have with us none other than Dave Foster, who is the founder and CEO of the 1031 Investor. So, guys, so you know who you're talking to and who you're listening to today. Dave is a degreed accountant and serial real estate investor. I like that word, serial, who was a qualified intermediary and consultant for tax saving structures and strategies such as a 1031 exchange and the Section 121 homestead exemption. So he started doing fix and flips in the 90s, realized that about 40% of his profits were going directly to the IRS. So he's going to share today some strategies and some updates on the rules and regulations on how you can utilize a 1031 tax exchange process in order to leverage your investment strategy. So Dave, welcome to the Exit Strategies Radio Show. How are you doing today?
I am doing absolutely awesome. It's great to be here with you, Corwin.
Well, thank you. So Dave, look, you have a heck of a story. So if you don't mind, give our listeners kind of a little bit about what it is that you have done that got you to where you are and what you're doing now.
Yeah, well, it's cool. You read the bio and all that did was make me tired. But it really all does come from the seminal event of having our first child. When we did that in Denver, Colorado, we realized that the most important commodity anybody has is not money, wealth, position, it's time. And this fits in, I think, so well with your show, Exit Strategies, because at some point in time, you want to be able to take the stuff that you have and trade that for time, because time is far more valuable. So when we had our first child, that was the big moment. And so like so many people today, we decided that the way to do this was for a Kansas farm boy and a Minneapolis city girl living in Denver, Colorado, to go buy a sailboat and sail around the world. Who knows how we got there? But we did, so we embarked on a career as real estate investors. But in my first project, which I thought I did really well on as a fix and flip, my accountant reminded me that I've got a silent partner named Uncle Sam. And that was going to put the schedule back way too far. But right at this moment in the mid-90s, a court case had been settled where the IRS had actually lost a huge court case on this thing called a 1031 exchange. And it was now going to be available to every investor. What it would have meant if I would have known about it 6 months earlier, that I could have sold that property and then gone and bought our next properties and used the tax dollars as part of that purchase, having to pay the tax. The 1031 exchange lets you sell investment real estate and buy investment real estate without paying the tax. You can continue using the tax dollars, and then the next time you sell, you use the old tax dollars plus the new tax dollars, and it just compounds. Amazing. So Fast forward 10 years, what we were able to do using this was to move our portfolio from Denver, Colorado to Connecticut to Florida, carving off some tax-free visas along the way. And we bought a sailboat, raised 4 boys on it, and funded our trip with my private clients and with our vacation rentals.
That is
How's
mad.
that for an exit?
Look here, that's out the door. That's gone.
Yeah, most amazing thing. And we really could not have done it that quickly if we were not using the government's tax dollars for our benefit. And so as I started doing that for myself, I saw what it could do for others and started a business, and here we are.
So a lot of people, Dave, I mean, because this is what you do as far as educating people about, if I remember correct, that court case was Starker or something, right?
Exactly. Starker. Yep.
And so a lot of people don't know about this program, and in turn they approach, this is something that we've been working diligently to educate our audience on, which is how to leverage up. We oftentimes approach this singular. We're single focused. We want to buy a piece of investment property. Sometimes it's a fix and flip. Sometimes it's a buy and hold, but we don't look at the growth opportunity and how we can leverage, like you just said. You take a property, you improve it, you get appreciation, you sell it, you defer the taxes, and reinvest all that money into the next property, how to leverage that up to increase the size of your portfolio substantially in a relatively quick amount of time. And that's what you did.
That's exactly right. The 1031 exchange was originally designed when it was put in the tax code in 1920. So this isn't some new hoodoo voodoo kind of thing.
Okay.
But it was put in the tax code in 1920 to allow farmers who, as we were trying to grow our agribusiness, farmers to be able to sell their farms and buy new farms. Because the problem that they were running into was that if they sold their farm, so much was coming out in tax that they couldn't afford to buy a bigger one. So the whole industry was stymied. So the IRS and government decided, let's let them keep the tax dollars and use it so they can buy bigger and bigger and bigger farms and grow that part of our country's economy. And it worked wonderfully. But what Starker did was it challenged that so that now people who just own a single family home or a small duplex can sell that and start to grow their portfolio the exact same way. You sell a single family rental, go buy 2 smaller ones. You sell a duplex, buy a small apartment. And that's the beautiful thing about the 1031.
And people miss that. So, to being able to leverage again up to that next property, quote unquote, to that higher level, when to be transparent about it, oftentimes we just thinking singularly, and then becomes the impediment for our growth. You guys have put together like a whole program that kind of that helps people get beyond that, correct?
Right. The things that's really curious about this, of course, is it's part of the tax code, so nobody understands it. And then secondly, the IRS has to let you do it, but they're certainly not going to market it for you. So it's been something that's been very difficult over the years for people to learn about, unless you're a nerd like me, who is an accountant and doesn't mind going 2 miles deep in a 2-foot wide creek. But that's what we did so that we could help others do it. It's really almost like, remember the old saying, I'm going 2 steps forward and 1 step back?
Yep.
When you sell real estate just normally, that's exactly what you're doing. You fixed it up, you generated appreciation, you built it up so that you could sell it and make this giant leap forward. But then you pay the tax, that takes you back a step. Then you do it again. You go, well, the 1031 exchange allows you to do 2 steps forward and then 2 more steps forward because you get to use the tax dollars. It just does everything for you that much more quickly. This is what's beautiful, is that it's designed to be used at any point in your life cycle. I like to talk about investors having a life cycle, right? When we start out, we're young, we don't know what we're doing. We don't know what we don't know. But we buy a house, ready, fire, aim, and let's become a real estate investor. And you can start right there, because with the now this is another important thing before I even go there, that this also isn't a DIY. You have to use, the IRS requires, an unrelated third party. That's the qualified intermediary. That's the part that people like me do. So again, we have to be able to market. Most of us are accountants and attorneys. We're boring as heck anyways. So we're horrible marketers. But that's why this thing's not really known. But when you're young, so you sell your first property, you do a 1031 exchange using a qualified intermediary. You sell your old property, you buy your new property, but that new property can be any type, any number, anywhere. That's the power. So like you were talking about buying one to grow your portfolio, sell one, buy two. You could also sell a place where appreciation is great and move that, like sell in California and go buy something maybe in the Research Triangle or down near you guys where cash flow is better. So you can start to shape your portfolio. As you get more experience, you can go into different types. You can sell residential, buy commercial, sell commercial, buy industrial, sell multifamily. And maybe it's that time in your life where a vacation would be nice. So you go buy short-term rentals where you get to use them some yourself. Again, you're doing all this without paying a penny in tax, which lets you leverage your portfolio at no expense to you. And you get to indefinitely defer paying that tax.
We had this conversation, in my office with our agents. I've participated over the years in a few 1031s, working as an agent in various transactions. One of our agents was sharing, they had a client up in, I think, Maryland area, Virginia, DC area, who ultimately wanted to retire down to Florida. And they sold a property in Maryland, investment property, bought the model home of a builder down in Florida, and then had the builder lease the model back from them. And that went on for a number of years while they completed the entire project. And then subsequently, when they finished it, sometime shortly thereafter, the people retired, and then they moved into the house. And obviously, when you convert the house, quote unquote, I know there's a term for that, which I'm gonna ask you to kind of share that with our listeners. But when you convert it, at that point in time is when you have taxes. But they were retired by then. They were 62, 65, or what have you at that time. So they were able to not only defer taxes initially, but then they were actually able to save on taxes when they did need to pay them, because they waited until after they reached retirement age.
Here's the industry term for that. It's called the Mac Daddy of all strategies. Yeah, I mean, kudos to them. That is. And by the way, they did not have to pay the tax when they moved in.
Okay.
Yeah. So there's 4 Ds of 1031 investing. The first one is to defer, because anytime you get to use the government's dollars instead of having to pay the tax, that's a day you make the money on it. So you sell a property, defer it. The second D is defer, because as you grow in your experience and life portfolio, you can sell in one location, do a 1031 and buy in another. You can sell different types, buy different types. You can sell and find the places that are underappreciated. But again, as long as you keep doing 1031s, you never pay the tax. What do you think the third D is?
What's the third D?
Defer. Defer. Because as you start to wind it down, that's exactly what you can do. You're a landlord in Cincinnati, Ohio. You're getting ready to retire. You start to 1031 your portfolio down to Sarasota, Florida. And then when you retire, your portfolio is around you. Or you 1031 into more and more passive opportunities so that you're not stressing during your retirement. When you leave Cincinnati to go retire, what your folks did, they're going to sell the house that they live in. Now that falls under Section 121. And if they've lived there for 2 out of the 5 years before they sell it, then they got the first $500,000 of profit tax-free. And you can do that once every 2 years. So they sell their house in Cincinnati. That money goes in their pocket. It's tax-free. Where are they going to move? Into one of their rental properties that's waiting for them in Sarasota, Florida. Now, they've deferred a ton of tax on that throughout their life, but as long as they don't sell it, they never pay the tax. Money from your primary sale, tax-free. You move into this house, keep the tax deferred. Can it get any better? It actually can.
No.
Because once you've owned that rental house for 5 years and then converted it, once you've lived in it for 2 out of the 5 years before you sell it, then when you sell that, you get to take a proration of the gain tax-free. I've got a realtor on St. Pete Beach that has 3 identical condos side by side. He moved into the first one to retire. They were investment properties that he 1031'd into. He's going to live in it for when he's ready to leave, he will sell it. Now, if he rented it for 2 years and he lived in it for 3, he would get 60% of the profit tax-free. Wow. So you literally can turn tax deferred into tax-free. Where do you think he's going to move when he leaves? Next door. It's beautiful.
Wow.
And he will continue to carve out a retirement strategy that simply involves coffee on your back veranda watching the beach, and every once in a while you move and you take some of that profit tax-free. So for everybody, we did this several times in our moves, and that was what bought the boat with tax-free dollars. Because every time we sold a primary residence, we put that money into the buy the boat kitty. So when we bought the boat, it was with tax-free dollars. So for anybody who's out there, well, let me talk about the 4th D first. I'm not even going to ask you to guess because you'd probably say defer and you'd be wrong. The 4th D is die. Now, I know it's not my favorite. It's not yours.
Yeah.
But we're all heading there anyway. So let's talk about the elephant in the room.
Okay.
When you pass away, your heirs get your property at what is called a step up in basis, which means all of the deferred tax that you 1031'd out of during your years disappears. Your estate doesn't pay it. Your heirs don't pay it. Nobody pays it. Your heirs get that property tax-free, and they get to start over as if they paid market value for that property with the day you died. So all of the things like depreciation, that comes back to them. Exactly. I have one family that's in Greenwich, Connecticut that I started with 23 years ago. Granddad did 1031 exchanges with us. When he died, his son got the properties and started over the exact same process. He just died a few years ago, and now his children have done the same thing. You know how much any of them have paid in capital gains tax over 23 years?
Whoa. Guys, for our listeners, guys, that ain't watching this, that was a 0. That was a goose egg. Hold on,
that was a goose egg. That's exactly right. Yeah, it's just amazing. So you defer, and then you die. And if you do it that way, you will never pay tax, and the tax will disappear. So everybody who says, and there are some naysayers once in a while, well, I got to pay the tax anyways. Why shouldn't I just pay it now? Because every day you keep the money is a day you make the money off of it. And because no, you don't ever have to pay it. There's plenty of off-ramps. It's a pretty powerful tool.
A lot of people are really kind of get hung up on such a limiting mindset, limiting belief. You know, people that do like what you do and what others do at quote unquote higher levels, like you do, they don't have that limiting belief. Like you said, you can defer, then you die, and your family can defer till they die. And then, you know, and it keeps going. But we miss that because we're so oftentimes so limiting in our beliefs, in our mindset, and we don't explore those opportunities. So thank you for dropping that nugget and that jewel on our listeners today.
Absolutely. These are the kind of things that many times any of us, we simply stumble onto them. And that's why it's so important to be watching and listening to podcasts just like yours, to always be educating yourself, to surround yourself. Life's mission, to always surround myself with people who are smarter than me. And
Uh-huh.
doggone it, it's been awfully easy. I'm always the dumbest guy in the room, and that's okay because I'll benefit from what they know and do. And
Mm-hmm.
that's why we started our company, was to help others get there. The nice thing about our industry as qualified intermediaries, I'm everybody's friend. I'm like Switzerland. You have to use me anyways. So I just as well give you free information, and then you can use us to do your 1031.
So for our listeners, Dave, I'm gonna ask you, if it was, what random nugget, so to speak, do you have for our listeners who may be thinking that, okay, well, look, I need to explore this. I haven't even thought about this, or I have property and maybe I love to, move up to a larger property, but I'm afraid of the taxes or what have you, capital gains that I would have to pay, because that is a deterrent for so many investors for them scaling up. And to be blunt about it, most real estate professionals, agents don't know about a 1031. I'm surprised at how many, when they're talking to someone, don't have that as a thought process to say, hey, you can do this and leverage up. So what nugget would you drop on them as far as something they should be aware of, or otherwise a thought process they should have in order to catapult them forward?
The single biggest thing is that if you're interested in doing something like this, you need to start planning. For us, it was a 10-year strategy. You don't develop 10-year strategies overnight. It takes time. And in addition to that, and even more importantly, to do a 1031 exchange, it always starts with the sale of your old property. In real estate, we think of buy, buy, buy. I buy and then I sell. With the 1031, and remember that old mantra, you make your money when you buy your real estate, because you buy it right. And that's really true. The 1031 exchange is exactly the opposite. The 1031 exchange starts when you sell, and the qualified intermediary has to be in place prior to that. I get calls every month from people who closed on a piece of property last week. I'm ready to do a 1031. No, you're not. That ship sailed because it wasn't documented on the settlement statement. Sorry, you can't do it. The QI has to be in place prior. And extremely important. So while you make money in real estate when you buy, you keep money when you sell and do the 1031. So I would say that of planning, along with the fact that real estate and 1031 investing is a patient game. Compound interest is best gained the longer it takes. So the longer you can keep things tax deferred. So a lot of our people, and you've got clients that do this all the time too, that love to fix and flip. When they sell after fix and flipping, they pay the highest tax rates there are. And they can't do a 1031 exchange because their intent was not to hold the property. Their intent was to resell it. So I spend a ton of my time counseling with fix and flippers, trying to talk them off that adrenaline ledge to say, instead of fixing and flipping, let's buy it, let's fix it, let's put a renter in it. And if you still got to get the adrenaline going, pull the property out, go buy your next flip right now. But let this first one sit. Once you've owned it a year, people feel comfortable with that, then you can sell it. But now you're not going to pay anything in tax, because you're going to do a 1031 exchange and you'll buy your next property. And we literally have clients who have done this model. They normally would have done one at a time, but because they're able to shape to this, they buy one, put it into rental service, refinance it, get their second one going in the first year. By year 2, they have 5 properties, and by the end of year 2.5, they have about 9 properties under the belt that are all in different. And come on, that'll keep you as busy as anything.
Yeah, that's true.
Guys that will literally do 30 exchanges a year because they've done this model. And every one of those properties they've owned for more than a year. So while all their properties are percolating, they're getting cash flow.
Yeah.
When they sell them, they don't pay tax. And then they force appreciate with the value add upgrades. And if you will be patient and do that throughout your life, you'll be incredibly rewarded.
That is awesome. That is an amazing nugget. I'm over here envisioning it. So for our listeners, guys, this is your opportunity for you to come outside of the box, so to speak, and do this differently. You have done it. You're living it. You're raised your family on a boat because that was your dream, and you've been able to leverage your knowledge of these programs and not only assist yourself but also help others to do the same thing. So, Dave, if you don't mind, as we kind of get to the end of our show for today, how can our listeners reach you? How can they get in contact with you?
We've tried to make it really easy for people. The website is the1031investor.com. And when you go on there, what we've done is pack that with resources and access points to us. One of the things that I think is most critical with the QI is that when you're talking to them, you don't want to talk to the operator or the marketing rep. You need to talk to the person who can actually help you flesh out the strategy. And the strategy comes out of 10,000 pages of case law. So you got to make sure you got access to the people who are really doing that. What we've done is we've put calculators on the site that you can use to help figure out your analysis versus doing a 1031 or not, what kind of tax you'll have, timing that goes with 1031s. We've got calculators for that. Heavens, I have a 32-part YouTube series that'll guaranteedly cure your insomnia, but it's all the types of strategies and things that we've used and that our clients are using to tax in your pocket. The1031investor.com.
Awesome. Well, Dave, thank you so much for that. And it's a beautiful website for our listeners, guys. Y'all please go there. He has a tremendous amount of resources there, right there, available for you, videos, all those things. Right there at your fingertips, so you can get some more information and then engage with Dave and his team so he can help you to make not only this strategy work for you, but to make it your own. And that's what's important. You got to own this strategy so you can find the success that you're really and truly after. We all say we want to invest. We all say we want to grow. We all say we want to create a legacy. But many times we don't take the necessary steps to make it happen. Dave is giving you a roadmap to help you to navigate to get further along than what you may get on your own. So y'all please make sure y'all tap in to that particular resource and contact Dave at the1031investor.com. So Dave, thank you so much for being on the show today. I really appreciate you taking time out of your busy schedule to educate our listeners. For our listeners, guys, please make sure that you go to our website, exitstrategiesradioshow.com, for this episode and other episodes so you can make sure that you continue to increase and grow your knowledge base. Make sure you subscribe, guys, so you can get this content delivered to you as we deliver it to everyone. Dave, again, thank you so much, my man, for taking time out your schedule today.
My pleasure.
To our listeners, guys, in closing, y'all know what I say. Y'all know how I feel. I'm going to put all that together right here and make it real for you, which is I love you, I love you, I love you. And we're going to see you guys out there in those streets.